How's it going, everybody? Brian Porter here from Keller Williams Realty, and I have your June Santa Clara County real estate market update. And I know we're already over halfway through the month, but I wanted to see what was going to come out of the FOMC meeting yesterday. And now that I have that information, I want to give you a rundown of what we're seeing right now. So obviously, you know that the housing market has been slowing down. I've been talking about this for a while, and now it's become quite a bit more apparent. And you're now starting to see it in the news and places like that. And so it's not quite as bad as some of those articles may make it sound. It actually still is a seller's market, but we are definitely seeing a real shift here currently. Why? Well, inflation is completely out of hand. I'm sure you've seen that at this point when you go to your local supermarket. Everything is more expensive. Gas is more expensive. Obviously, housing is more expensive. And so the Federal Reserve is trying to combat that. And so what they had been doing, they had been doing 50 basis point interest rate increases, which is about 0.5% as it pertains to your interest rate. And what they had said last month is that they were not expecting to do any 75 basis point increases this year unless they had months and months of data to show that that needed to happen. Unfortunately, the data was a little bit worse than they had expected, that following month. And so what they did yesterday was a 75 basis point interest rate increase. Now they're sounding like they're probably going to do that again this year, and just two of those is about 1.5%, and that is going to be about 15% of your buying power. Every time interest rates go up 1%, you're looking at about a 15% decrease in your buying power. And that is huge. And so what we're seeing right now, because the banks, I don't believe, had priced in 75 basis point interest rate increases, they were thinking 50 basis point increases, we just got a half-point interest rate increase all in a 7-day period, and that's coming from Freddie Mac. So that's what we're looking at right now. Our interest rates are literally double what they were last year. However, historically they are still decently low. So that's the good news. But it is starting to have an effect on the market. We are seeing fewer people come through open houses. We are seeing fewer offers on properties. And I also do think that we are going to be seeing a little bit of a decline in pricing, which is needed because we can't go up in a straight line forever. So we saw about a 0.6% decrease in prices between April and May. And then going into June, I think that's actually going to be increased by quite a bit based on some of the listings that I've put up and some of the buyers that I've worked with recently. I think that we're probably going to see something more like 7%, give or take a percent or two, when we get the numbers back for June in July. So I will be coming to you with an update then to let you know what we're seeing at that point, but that's just kind of what I'm expecting. As far as inventory, we saw a 50% increase in inventory between April and May, and that is starting to increase rapidly as well. So in a more balanced market between buyer and seller, you would expect to have about 3 months of inventory. So if we were to stop putting houses on the market today, that stock would last for about 3 months. We've been sub 1 month for most of the years previous, from like 2017 until just very recently. And so inventory has been incredibly low. It still is low, but I would expect to see us get closer to that 2-month range, which is going to allow for buyers to have more options. It's going to allow us to price homes more kind of what they're valued for, not way under, shooting for way over, because we have so many buyers. I think it's just going to become a bit more balanced. As far as days to sell, we've been hanging around 7 to 8 days to sell a home for a very long time, and it's been kind of artificial, as I've said in the past, because we would probably be selling those homes in like an hour if we weren't setting offer due dates for 7 days out and then taking a day to negotiate, hence the 7 to 8 days on market staying pretty much the same for years and years and years. But we did see that increase to 9 days. And, I started to feel like it might be increasing more than that, but we didn't have the numbers for June yet. Those will come out in July. So what I did is I looked at anything that went pending or sold in the first 2 weeks of June in just a few areas. Otherwise, it would have taken me forever to figure it out. But this is going to be for Santa Teresa, Blossom Valley, and Cambrian Park. So some of the hotter areas of San Jose currently. And what I'm looking at right now is when you look at the very, very recent sales, those homes were on the market for more like 14 days. And so that's still fast compared to, let's say, a full-on buyer's market, but it is significantly different, which tells me that we are getting fewer multiple offer situations. We probably have a lot of people that they're trying to kind of, price their houses a little bit high to see if they can squeak out like a record sale before things correct a little bit. Not a good idea in this market. And so that's what we're seeing right now. And so what we're going to start to do is probably get that list to sale ratio to get closer to 100%, where it has been, 110, 115%. Meaning homes were selling 10, 15% or more over what they were listed for. And so I think that we're going to see that number come down as we get fewer and fewer offers, as homes sit on the market for a little bit longer. And I think that's good, because when you're going to go to sell a $1.5 million house, you don't have to list it for $1.2 million and just hope that you get what you actually want to get for it. And usually you will, but you just never know. Whereas now, if you have a $1.5 million house, we're probably going to list it for $1,499,000, and we might sit on the market for a couple of weeks, maybe even a few weeks, but then sell it very close to what it's actually valued. That's great for the buyer, and it's honestly, I think, less stressful for the seller as well. And so, I think that we are going to see a more balanced market. I think that we will see prices retrace a bit. I think that it would be crazy to me to see prices continue to go up like they had been in an environment that is this inflationary, and in an environment where we are battling that inflation by increasing interest rates, pretty drastically. However, even if we were to be in a recession right now, which I think we might be, or if we're headed into a recession, which I think that if we're not in one now, we could easily be in one soon, I'd like to show you what home prices actually have done in previous recessions. Because I know a lot of people think, oh, recession, 2008, everything's going to drop by half. That's just not the case. If you look at history, you look at the history of the recessions we've had in the past, it hasn't had the crazy impact on the housing market that you would have seen in 2008. So really quickly, let's jump into those numbers. All right, so this chart comes from the Federal Reserve Bank of St. Louis, Missouri, and this is showing you the median price for U.S. homes over time. And I almost feel like I don't really need to say too much more than that because you can see the trajectory of home prices. And actually those shaded areas that you see, those are recorded recessions. And so as you can see, it doesn't even always have an effect on home prices. I think this one will a bit because home prices have been heating up so quickly, but I don't think it's going to be quite as bad as people seem to think. So let's take a look at the first one here. And this is going to be 1970 to 1971. And when you see down here, you're going to see anytime I put recovery time, that means that prices did dip at some level. You can see they didn't really dip much, but I will put down how long did it take for prices to get back to around the level they were previous to the recession or over. When did they make that jump to either match or go over? And so in this case, it took 12 months and you were already back in equity. Let's take a look at number two. We've got Q4 of 1973 through Q1 of 1975. I didn't put a recovery time because prices actually just continue to increase the entire time. Looking at number three, Q1 of 1980 to Q3 of 1980. Again, no recovery time, a very quick recession, and prices just continued up. Let's go to number four. Again, prices continued basically up. There was a little dip in there for a minute, but throughout the majority of that recession, which again wasn't very long, we saw prices increase. Now here we go, number five. Here's the one where we did see a longer recovery time. 36 months. So Q2 1990 through Q2 of 1993, that's a 36-month, 3-year period. And it took just 36 months for prices to recover at that time. This one I find here is pretty interesting because that is the dot-com bust. And so what we saw there was a very quick recovery time as well. And so prices did drop, but it took literally 3 months for you to be in substantial equity from the beginning of that bust. Now, here's the one that everyone's afraid of. And that was obviously the housing crash. Why did it take so long for houses to recover during that time period? Well, because the housing market basically caused that crash in the first place. The people that were buying homes then could not afford the homes that they were purchasing when they purchased them. It wasn't because of an economic downturn. and all of a sudden they couldn't afford their home. It was partly that, but it was mainly because a lot of the people that were buying these super expensive homes were buying homes that were millions of dollars, sometimes more than they could actually afford. People that had absolutely no business getting into real estate at that point were able to buy multiple properties. And of course, that is not sustainable. And that is why it took so long for that one to recover. And that's why housing prices dipped as much as they did. Even with that said, if you had bought a home at the absolute worst possible time, you're looking at a 6-year time period in order for you to end up breaking even. So about the same amount of time as most people's new car loans at this point. And your home would have taken that dip, but assuming you held on to it, you came out the other side 6 years later. And at that point, we know what happened to the market after that. So the current market, the current economic stuff that we're seeing right now is not being caused by the housing market itself. It's being caused by inflation from a whole lot of other, for a whole lot of other reasons that I'm not going to get into. I am not an economist, but it's certainly fairly easy to show a chart like this that basically speaks for itself. So I wanted to show that to you. I thought that was kind of cool, very valuable. So if you're thinking about, purchasing a home, I hope this makes you feel a little bit better about that. Maybe you just purchased a home. It's going to be okay. We're going to see prices continue up, even if we see prices retract a little bit in the short term. And so, if you're out there looking for properties, there are more options. There is less competition, especially if you're somebody that's utilizing an FHA loan or a VA loan or something like that, that was very difficult before. You can do that now. Or if you're looking to do a home purchase and a home sale at the same time, if you're looking about upgrading, that was very, very difficult when it was extremely hard to find a replacement property. Whereas now we're in a balanced enough market where it's very possible. And the good news is you're not selling at a loss when you're also buying at a decreased price as well. So anyway, that's about it for me. I know this was kind of a long one. So if you do have any questions, please let me know. My phone number is 408-813-6865. My email address is my first name dot last name @kw.com. And I will look forward to talking to you again next month. Take care. Bye.